Okay, let's begin our class. Just want to give you a reminder. We have the very last session scheduled on May 4th, the 4th of May, and this is Sunday, a Sunday. All right. Sorry about that. Sorry for the any inconvenience created. Because I cannot arrange any other better day. I know you have a class on May 3rd, so I cannot use this classroom. So remember, you must show up on May 4th. That is the last day for your final presentation, and each of you will come out here to do your oral presentation. It's about 15 minutes. Highly recommend you can. You should have started to finalize your topic already, and go ahead to collect information and do the research. And highly recommend you can also design and produce your very fancy presentation materials, and you can use animation, your video, use music, whatever you think is very attractive to your audience. And also, this is a very good opportunity for you to practice how to draw the attention from your audience, how to impress your audience. Okay, so you have 15 minutes to do your final presentation. All right, that is scheduled on May 4th, Sunday. Okay, same schedule from 9:30 to 12. Right, and that presentation will account for like 30% of your final grade. So it's very, very heavy. So please to start. Okay, it's not too early to start.
Should we send it to you before to get feedback?
Well, if you really want to, but it's not necessary. If you want to discuss with your classmate, it's fine. You want to give me the first draft and ask me, my opinion, that it should be fine. And you are totally on your own, so you are not limited to. You are free to do it, but not limited to. So for today, we will talk about the different type of business organization. And hopefully you can use either one to fit in to your business model. Okay, and also hopefully this topic will become part of your final presentation, because when you come out to here on this stage for your final presentation, you need to present your business. Okay, hopefully it's a real one, but you're gonna use it in the future, hopefully. So I hope you can utilize this business topic today, okay, for your future business development, and also at least as part of your final presentation. You need to talk about your business model and to present to your audience why you choose this type of business organization. Why? The reason why was a benefit for you. But probably you can talk about what will be the risk for your business model if you choose this organization. Okay, so we're gonna talk about that, and also highly recommend you want to discuss with me and with your classmate today, and to talk about what's the benefit, what's the risk, what's the problem for the type of organization you choose. All right. So the first one start with is always the simple one. Okay, the simplest one is a sole proprietorship. Okay, but assuming this is only one person. Okay, only one person. Even in California, okay, husband and wife may be considered as a sole proprietorship. In California, we are the community property. Okay, you can conduct this business as a sole proprietorship. But for next week, for next session, we're gonna talk about the tax consequence. Okay, so eventually for today and for next session is back-to-back topic. For today, we're more focused on which type of business is suitable for your business. However, we will talk about the tax consequence, and doesn't matter which type you choose, there is specific tax consequence to follow up. All right. So for example, if you choose sole proprietorship as your business organization, for next session we're going to talk about you will file the tax under your personal. So for individual tax is 1040, 1040. Okay, and under the 1040, you will see the Schedule C, like Charlie. Okay, Schedule C. That is the tax report, the tax return. You're gonna file your business income and also your business expenses to see by the end of the year, did you create the net profit or net loss? Okay, if it's net profit, you have a positive income and carry over to your personal. But if you create or you know, by the end of the year, you see the loss, the net loss. By the same token, you can negate your other gross income, which is not necessarily too bad, you know. So if you see the net loss from your sole proprietorship business, by the end of the year, you can carry over that net loss to offset, to negate your other gross income. So, you know, not too bad, you know, it's a tax deductible. Okay, so we will see it. Okay, however, just give you a head up. Okay, for the husband and wife, even though you're running your business as a sole proprietorship, however, on your Schedule C, you can only have one person. So, say for example, husband and wife. In my case, because I coach a lot of real estate agents. Okay, eventually right after this class, I have another class. This is a real estate class. Okay. So for example, both husband and wife, they are both real estate agents, and each of them running their business as a sole proprietorship. By the end of the year, they have to file Schedule C individually. Even though they can file the 1040 as a married couple jointly, however, when they filed Schedule C, I'll show you what Schedule C is next time, okay? It's a piece of form, 2 pages. Okay, IRS tax form. Okay, so even the husband and wife, they work together, okay, as a team. However, by the end of the year, they need to file the Schedule C individually. Okay, I will show you how to do it. Even under the same business, say real estate business. Okay, however, each of them must file their Schedule C. So be careful. Okay, when you choose, you know, the sole proprietorship, and the benefit, the good thing is, it's very simple, and you do not see too much organization or setup fee. We will compare the setup fee to the other. Okay, let me give you the number. Okay, let me give the number. If you want to run your own business as a sole proprietorship, only thing you need to do, even it's not required by law, but better off to do this. Okay, the only thing you need to do is just go to your county office. Just go to your county office to file fictitious business name. Fictitious business name. So we say this is a FBN. You go to each county website. You do the research. Say I want to search the form. It's the application of FBN, fictitious business name. So for example, James Gao go to his county office, okay, and then file this. Usually it's only like $35 filing fee, usually more or less, and good for 5 years. Of course, if this is your initial application, initially this is the first time you apply it, you are required to publish this application in the local newspaper. Another $50. So I would say within $100, and you can have this done in 1/2 day. In 1/2 day, go there in the morning, then you have everything done. You fax or email this application to the local newspaper. Then you're done. You spend less than $100. Then you just bring the copy of this application form with the stamp. Of course, there's a number, there's an ID number on this form with the stamp, with the signature of the county clerk. Then you can go to any bank. You can go to any commercial bank to open up your business checking account. That really means from that moment on, you are able to start your business transaction. With the check, you deposit, transfer the fund from your personal account to this newly set up business checking account. So you transfer, I don't know, $100, $500. So your business is there. And then you can issue the check to purchase any inventory, purchase any equipment from this checking account. And once you do your business sales, you can receive the money or funds from your customer. Then you're done. All right. So the benefit for sole proprietorship is one, timing, very quick. If you really want to do it, within 1/2 day, you set up already. Number two, least, very less cost, very almost everybody affordable. Okay, so very cost efficient, very cost efficient. All right, and 2 points here. Okay, there are 2 points here. Number one, which county you are going to. There are 58 counties in California. Which county you will choose, and that really depends on where is your business location. And by law, there is no problem. You can use your residence address. No problem. In California, there is no any law prohibited. Okay, but as long as there is no traffic, you cannot operate your business at your residence if that is a retail store, because you will attract too many traffic coming in. If that is not too many traffic, so if we want to, well, by the way, you don't care about your privacy. Okay, there is no privacy issue. There is no too much security issue. You don't mind your client come to see you at your residence, so that should be fine. All right. So, for example, if you start out your consulting business, all right, or any kind of service type business, for example, for the CPA service, for counseling service, for whatsoever, as long as there's no security issue, okay? If there's no security issue and no too much traffic issue, and should be fine. So though there's no reason why you do not use your residence, because you don't pay too much. You don't pay extra rental expenses for your business. All right. So even the Apple computer start from garage, right? So start garage type business is almost like spirit of Silicon Valley. So nothing wrong, start from your garage, from your residence. So no problem. So really depends on really depends on where the location of your business is. So I think usually could be the same one as your residence. Nothing wrong. Yes.
What is a fictitious name?
Fictitious name, okay. Anything is not real. Say we say legal name, right? You have your legal name, right? Legal name means the true name which identify who you are, right? However, Well, you want to differentiate from your personal to your business. So if nothing wrong, I say you want to file your fictitious name as Robert Bruce. However, not just Robert Bruce. Say Robert Bruce Engineering Consulting Service, for example. And for the majority of my students may say Robert Bruce Real Estate Service, for example, right? And the reason why is they want to differentiate the event you are involved is not your personal social life. That's very important. For example, if you do not set out your Robert Bruce Engineering Consulting Services, for example, and when you have any business type meeting with your friend, with your client, potential client, and you invite them to the lunch, you spend $20. This $20 is arguable as your social life. Then you cannot deduct this $20 from your total gross income. Once you set up your business, even under the same name, however, you already separate these incidents from your personal life. So you know you're doing almost the same thing, very similar. You invite your buddy for the lunch. You spend $20. We'll talk about this. And somehow during this lunch meeting, you talk about a little bit about the potential business. Not 100%, even a little bit. You talk about potential business. Then you are qualified to deduct this $20. But according to tax law, even you qualify for the meal deduction, but it's only 50%. But better than nothing. Okay. So in order to answer Robert's questions, what is fictitious name? The reason why you want to set up the fictitious name because you want to separate certain event during your life or during your activity, okay, among your activities. You want to separate, you want to identify, you want to designate this type activity is your business activity. And of course, this is very important. For your bookkeeping reason, for your tax reason, you want to identify, you want to designate this event, this activity is under your business.
So you have to use your real name as part of the fictitious?
No, never. Eventually, I just use a very extreme example. For myself, I would like to use my Samuel Tong because I want to promote myself. So it really depends on you. So for example, the class after this, following this, is my real estate class. So I choose my business name as a Samuel Tong School. And the reason why is I want to promote my name. Once people recognize Samuel Tong School, I got, after 15 years business, I have a lot of referral, So this is one way you may consider to use your personal name.
But if you don't use your personal name as part of the FBN,
totally fine.
Do you have to make sure that nobody else has the same?
Yes, of course, right. Yes. So this is another point I want to remind you. Okay, one's the location. Okay, location is easy, right? You can have multiple locations, but you choose one as the main office. So that's easy. Then let's talk about the name. Okay, name is big deal. It's big deal. Okay. On one side, you want to use the name will be very easy to memorize and recognize. Right? This of course makes sense, right? But another side, you don't want to trip on somebody's toe. You want to stay away, right? So how can you balance it, right? You cannot run another Apple computer. That's for sure. So you want to pick out the names will be very easy, be recognized and memorized from the market. That's one way. However, the other way you cannot hit to somebody else. So, but the good thing is, in this area, sole proprietorship, okay, because at this level is regulate and keep the record at the county level, is lowest level, okay? So they don't check the name. They ask you to check the name. So there's no surprise, so many people have the same name. Guess what is the most popular one? Guess.
ABC something.
Triple A eventually. AA. The reason why start from the alphabetic letter A. So when people do the research or when your phone number list in the phone book, it's always on the top. Sometimes you even come back with the number, because number even is more higher priority than the letter, than the alphabetic. So if you go to check at the county level, the name come with the number with AAA. That is the most popular one. So many AAA there, but well, as long as the other people they don't complain, that is what publication for. That is why county require you to publish this in the local newspaper. So once you publish for 3 weeks, no anybody complain, then this is it. It's done. Unless there is infringe of trademark issue. If there's no trademark, no patent issue, no copyright issue, just merely for the name, this is a very, very low priority. So as I say, you are free, you are wide open, okay, for you to choose your business name whatsoever. So as I say, the balance is, in one side you want people to recognize it easily and also memorize it easily, but the other side you don't want to get a complaint from the other big company. All right, so that is the guidance for you to pick out the name.
So what happens if you choose a name and there's an existing name already registered?
Very easy, very easy. This is not even what if, this is almost 90%. Whatever the name you think is good is been picked already, right?
So if you put it published in the newspaper,
nobody even care about that.
yeah, I mean that company doesn't complain. You can still use the same name if the person didn't complain.
Assuming there is no trademark infringe, because even they don't complain at the name, they may file a lawsuit against you to protect their trademark. So this is different level. I just say, assuming there's no trademark issue, usually people they don't care about the name, because like James Scott, I believe thousands James Scott, right? So nothing wrong to pick out the same name, as long as well, after the publication period and nobody complained, then this is it. If somebody complained, then usually the people in behind must give away. That makes sense, right? Even there's no trademark issue, but the people in behind give away, change the name. Either change the name or you add 1 or 2 more, single word in between. It should be fine. Not just exactly 100%. All right, so it should be fine.
So in other words, if I name my business Apple, what am I selling candies instead of computer?
Should be fine. You name your business Apple, you sell Apple. How about that?
Sell apples, yeah.
This is 100% safe, right? Because Apple is not really the trademark for Apple, right? Apple is Apple, so you have your business is a Apple store and you're selling Apple. I guarantee you're 100% safe. Nobody can challenge you, This is not even a trademark.
It's probably a trademark that it's registered, right? I mean, I'm sure.
Right, but trademark you cannot use trademark Apple for Apple. Understood? If you are selling Apple, you have Apple fruits, you have fruits stamp there, and you use Apple store selling Apple, nobody can use this as a his or her or is trademark. Because Apple is a general term for these fruits already, and nobody can use it as a trademark. So that's why you can use Apple as a computer trademark, You can use Apple as the music, right? There's a music company, it's a Beatles music company, right? Apple record, right? This is another big company. So you can use Apple to sell your music, to sell your record. You can use Apple to sell your computer as a trademark, but no one can claim use Apple to sell Apple, because that is just general term. Just like desk is desk. You can use a desk as a trademark, say Autodesk as a computer software. However, you cannot use a desk to sell desk. This is a fundamental rule. But there's no sense because everybody can use Apple to sell Apple, so there's no really nothing really protection. This is such general, so there's no. We don't even bother. We don't even bother. All right. So again, come back to our. I would rather spend more time for the sole proprietorship, because I would say 95% for your new business. Okay, 95%, even more than 95% for any new business, and the owner will start from sole proprietorship. Okay, so very short time turnaround, very low cost to start with, and easy to maintain. And by the end of the year, you just keep your bookkeeping, okay, accounting bookkeeping. And we will talk about accounting for the summertime. Once you learn the basic principle, you can keep your bookkeeping.
So, let's say I registered a sole proprietorship business, but I'm not active all year.
You don't have any activities?
I don't have any activities, but just expenses. I mean, I'm just going to
Good
one
point.
extreme.
Very good point.
I'm just curious because of the tax advantage, right?
No, there's no tax advantage. So let me repeat Robert's scenario, okay? Say one person start out, not just sole proprietorship, any kind of business. And you set this up, say mid of March, like on Monday, okay? So you spend $100, application, recording, already. And down the road, for the whole year, you spend this, computer, spend that, for copy machine, whatsoever. So by the end of the year, totally you spend, well, you even invite your buddy for lunch. Don't forget that, right? For party, for lunch, for ball game. So by the end of the year, you spend total $3,000. However, you just realize you have not done any business yet. Throughout the year, you only spend the money and no any revenue coming in. And Robert's input or question is, can I deduct this $3,000 from my gross income from any other source? Can I do it? The answer is no. Okay, the answer is no. Because the tax code try to prevent people, try to prohibit people do nothing but only spending the money. You see, this is a big loophole, right? If tax code allowed anybody to do this, then everybody just set up the business, not really want to run the business, just want to report expenses. Right? As I say, the main purpose to set out your fictitious business name is you want to separate or identify certain activities is your business, right? So everybody learn that, so everybody open out this business account. However, their real purpose is not really run business, just spend the money, right? Before you set out this business, when you spend the money, you have nothing to report. But after this, you can report as a business expense. So if tax code does not set out any limit, then everybody can report the personal, supposed to be personal expenses as business expenses. So come back to Robert's scenario, okay? Even you sincerely, truthfully, okay, you do your business. However, by the end of the whole year, there is none there's no any business revenue, then the tax code will say sorry about that. All of the money you spend become part of set-up fee. It is not expenses. For the tax, there are two major concepts very important. The money you spend is either go to expenses category or go to your cost basis category. If the money you spend could be qualified as expenses, then you can deduct it and offset your gross income. However, if the money you spend is identified as a capital, this is a capital, then the capital can only increase or add on your cost basis. For example, by the end of the year, the whole business spent total $3,000, but without any revenue coming in, according to the tax code said this 3,000 become your capital. Become your capital. That means the business of your the cost of the business is $3,000. What's that mean? That means if you by any chance you can sell your business to somebody else for $5,000, then 5,000 deduct 3,000, you recognize $2,000 capital gain. But think about it, what's the chance of that? Zero, almost zero. Without zero revenue, who is going to buy your business? Because everybody can easily set up their business, right? So in order to be qualified as expenses, you must somehow have revenue. Some revenue. Real revenue, okay? Not fake, okay? Not phony, okay? Must be real. Even by $10, $20, as long as IRS can verify it, it's a true revenue, then boom, you can report $3,000 as expenses and deduct it. So that's the trick. That's the trick. Because from the point of IRS might curious, how come you done your business for the whole year without any income? And that is not unusual for the Silicon Valley typical startup company, right? For the startup company in the Silicon Valley, it's almost like typical. For the first 3 years, 5 years, no any income. You can only spend the money. So sorry about that. You can run report this. Everything, each dollar you spend, add it on to your capital. That makes sense.
If you put some money in the bank, can you consider interest rate as your business income?
No. Yeah, good point. Yeah, very good point. The very smart people like James will think about that. Okay, let's create the income. Okay, let's create the income. How about I just deposit $100,000 into the bank, right? And I earn 1%. I put on the CD there, right? So after a year, I have $1,000 income. Oh, good, right? But even the smarter people at IRS, they say, okay, even though you have income, let's differentiate income. Okay, we say one income is your operational income, the income from your regular operation. The other one is from your non-operational, non-operational income, right? So even though you can recognize you receive $1,000 from your interest, however, if your business is not in this money business, even you have a gain from stock market, they will be treated as non-business income. It's not your business income. So if you have non-business income, there are some may challenge. I would say not necessarily 100%, but IRS may come in to challenge and say you can offset. You can only offset your operating expenses versus your operating income. So that's very tricky, it's very tricky. Yeah.
So if I incur some cost, I won't be able to deduct them from first year, even the first couple of years.
Yes.
Without that cost to be able to deduct from future?
Yeah. Yes. By regulation, you have 5 years to deduct. 5 years, but you divide it by 5. So the first year you cannot deduct, then it's gone. So for example, in Robert's case, say you totally spent $3,000 for the whole year, for the first year, then you have nothing to deduct from, right? So you have $3,000 divided by 5 years. So each year you can deduct by $600. Yeah, but for the first year, because you have nothing to deduct from, so $600 become already. So $600 become your capital. Right? But by the way, okay, this is tax law. But in reality, for the small business, if you deduct $3,000 and you offset $1,000 from your non-business income, I don't believe IRS will come in to file trouble because they don't have the staff to do that. Okay, they don't have the manpower to do that. Okay, so in reality, you have $1,000 from the interest income, and then you have $3,000 as annual expenses. So you deduct it. So by the end of the year, you have a total $2,000 net loss from a business. You still report this $2,000 loss on your 10404 form. Then you can deduct $2,000 from your any other gross income. This is the reality. But to be safe, well, you better off figure out another way.
You reported using Schedule C?
You report, we will see the Schedule C next time, okay? Because it's good I remind you, there is a form under the name Schedule C, okay? Because this is a very, very important form for the people to run your business as a sole proprietorship. Because I would say one of the major reasons for people to run the business probably is not to earn the money, probably is to report the loss legally. Because for some people, they have a very, very high gross income from another source. Unfortunately, probably from W-2 source. You know, W-2 income is the worst income in the whole world. Okay? Number one, W-2 income subject to payroll tax. That is almost about 18%. Okay, when we say payroll tax, they're including tax withhold. Okay, so if your company issued a check $10,000 per month, and there's a certain amount, depends on how many independent, you're married or not, or single. A lot of factors will determine what is the rate of tax withholding. So that's a big thing, all right? And number two, you need to pay the Social Security, 12% something. And number three, pay for the Medicare, that kind of thing. So altogether, probably, I don't know, more than 20% already. So, you know, on the contract, your company is supposed to give you $10,000 per month, but the money you take home probably is like $7,000. $3,000 is gone already. So W-2 income, that's the worst. And also, there's no deduction. There's no, even you commute, travel to your company every day, doesn't matter the distance. Okay, there's no deduction. Okay, for the commute, there's no any deduction. For the parking, there's no deduction. All right. So for those people, very, very common in Silicon Valley. If husband and wife and one spouse generate very high W-2 income, they should or they may consider to have another spouse to run the business. So just give the idea. This is a very, very common combination in Silicon Valley. If one spouse generate high income, say $300,000 easily in Silicon Valley, okay? If one spouse generate 200, 300, very high W-2 income, and they should seriously consider have the other spouse to carry on personal business. And the good thing is, if the business is running very well, they can add more income. But in case not so lucky, at least they can, you know.
Either way, there's a benefit, right?
Right, either way. You know, sometimes you never know, probably some other day the business income may even higher than W-2 income. You never know. But if you don't study that, you never get a chance. Especially for the small business, in the first 3 years, 5 years, probably you're lucky you break even, and usually you have loss, right? But that's the money you have to spend in order to see successful in the future, right? So this is a very, very common combination. right? So, however, when we talk about the benefit of, after we talk about the benefit of the sole proprietorship, the problem for sole proprietorship is there's no liability protection. It's an unlimited liability because this is your personal business. So when I say unlimited liability, mean in case your business incur any debt, okay, incur any debt, your personal must be liable for all of the debt, okay. So in the regular course of business, usually you can see the debt probably from your rental, for example. If you rent the facility, office, truck, any equipment, right? And probably liable for your employee, right? By the way, employee benefit or salary obligation will never be gone. The salary and also tax liability, they will never be gone. Even the person filed Chapter 7 bankruptcy, any dollar you owe to the employee will be there forever. Okay.
Under your name, not necessarily under the
bankruptcy code.
Yeah.
Right, under the bankruptcy code. Under the bankruptcy code is a certain debt liability will never be discharged. So you owe the money to your employee, doesn't matter if it's sole proprietorship or corporation or whatsoever, okay? Any debt owed to employee, owed to the government, and or owed to any injury debt. Okay, if you drive the car, hit somebody, and you are liable for $100,000 for that, you cannot file bankruptcy. Okay, for any tort injury, you will be there. Another thing is, if anybody violates number 8, security law, okay, that's a big issue. Okay, we'll talk about it a little bit. Okay, anybody violate state or federal security law, okay, you issue the stock to somebody without the approval from the SEC, without the legal procedure. You issue stock. Of course, you can issue stock, okay, as long as there's no argument, all right? But if you issue the stock to anybody without the approval of SEC, and if any violation found, and the issuer, if it's liable to cover the damages, that kind of debt obligation will never be discharged. So serious, all right? So at this moment, just bring your attention, okay? Bring your attention. For the sole proprietorship, you need to think about what will be the risk. What could be the risk, okay? Especially if you run in some business is highly regulated by the law. Say for example, automobile repair, for example, right? The auto shop, right? Or you are selling the liquor store, alcoholic store, okay? That kind of thing. Of course, selling the weapon, fire gun. This is a very, very high level of danger, all right? High level of regulation by the state, by the federal, and you don't want to run that kind of business as a sole proprietorship. Okay, you need to consider something else. All right. Other than that, small business, I would say, should be fine. Beauty shop, I don't know. Is beauty shop kind of risky? I don't know. You hurt a customer? I don't know. Yeah. Anyway, so there's one thing, okay? So sole proprietorship, as I say, is the most popular one for, I would say, more than 95% new business. Consider it.
So if I have a business for like 2 years or 3 years, and don't see anything going anywhere and changing to do different, still keep the same name.
You can do that. Okay. You can do that. Yeah, let me repeat James' scenario. So if I run any business, initially as a sole proprietorship, but even without any sales, without any revenue, few years down the road you want to convert it to another type, that's fine. And keep your same name, absolutely, no problem. Usually, by the way, okay, when I deal with my client, I always advise them to create a name. You remember SSA, right? There is eventually there is one area to talk about the name eventually, okay? To talk about the business name, this is a big thing. Because you don't want to change your name down the road, right? You want to keep your name, right? The name is very important, right? So one way you want to impress your potential customer, attract their attention, right? However, the other side, you don't want to infringe, okay, run into somebody else. So there is the balance. So usually I will, you know that eventually, create a name. You try to combine two names together, two vocabulary together to create one very unique name, right? That's one way. That's one way. So probably you can think about this. All right. There is one major limitation for sole proprietorship. Guess what? Guess what? What's the biggest and which prevent you to run your business as a sole proprietorship? You really want to do it. You want to save money. You want to save time. And you know, Professor Tong say, no, it's good to have a sole proprietorship to start out your business. But there's one factor coming in which totally prevent you, stop you by using sole proprietorship. What's the matter? What's the matter? What is biggest?